mean, some of them are literally down 99%. Other ones are down, you know, kind of of what you normally see in a Bitcoin bear market, because I think that's where the euphoria was. I think there was not a lot of euphoria in, baseline unlevered Bitcoin. And so I think that, while it's obviously been a pretty severe market downturn, like something like 50% at this point, a little over at kind of the intraday lows, I think that we're not going to see one of those, like, 85 or 90% drawdowns is my base case. I think we're closer to the bottom than the top. I think most of the pain's behind us. Not to say that the bottom is certainly in, but I think the worst part of the sell-off is behind us. We probably have a grind to go through until we're kind of back in a true bull market. And I think that, yeah, the most of the pain was in the levered. And so a little bit of both. So just because something becomes extreme doesn't mean it's wrong. For example, when Nvidia just, soared a few years ago, it became overbought on pretty much any, RSI metric you're looking at, but it stayed elevated because the fundamental reasons were real, that the whole world suddenly wants like 10x or more GPUs than it wanted before. And I think the same is true for these RAM stocks. A lot of them have just hit obscene levels of like technical overbought status, but I think they're reflecting a pretty persistent shift in our demand for RAM on a persistent basis. And I think the way I've described the precious metals bull run is that while I have been concerned around the sheer speed that they've moved
Hmm.
and therefore their overbought status, like I used to be bullish on them in the sense that I viewed the downside as very low. Many of them, especially silver and platinum, but also to some extent gold, were pretty close to their mining costs. They were very underowned, and yet I viewed them as having a lot of upside potential. Now that they've had this big move, they're less asymmetric in the sense that I would not be surprised to see precious metals fall 50%, but I would not be surprised to see them grind higher either. They're just like the overall asymmetry is not there anymore. And I think that it's not that they become a bubble or overvalued. I think that gold, silver, and platinum were undervalued. I think that they were underowned, undervalued compared to the advantages that they have. And the market kind of quickly right sized them. So I think they went from undervalued to somewhere in the ballpark of fairly valued pretty quickly. So I view it as a locally overbought period, but that is pretty much backed by fundamentals. Like it makes sense for them to be at roughly these levels. As far as Bitcoin's concerned, I do think it's oversold. I think it's been kind of artificially lumped in with the software stocks more than it should have been, like we talked about before. So it's correlating with them oddly closely for no particular reason. I think the washout from the Treasury MNAVs, the Treasury company MNAVs, was painful. I think that had to be kind of worked through. The quantum FUD had to be explored to some degree. I think that makes sense. The 4-year cycle had to be tested, kind of self-fulfilling prophecy. But I think, like I said before, I think the majority of the pain's behind us. And if I had to bet Bitcoin versus gold over the next 2 to 3 years, I would bet Bitcoin. Doesn't mean it's 100% likely to outperform. And I like to own both, and I have owned both, and I still own both. But, if I had to say, okay, gun to my head, if I had to say which one I think outperforms, I would say Bitcoin, because I think that gold is somewhat euphoric at the moment. I wouldn't say it's a bubble, but it's somewhat euphoric, and I think that sentiment on Bitcoin is somewhat unfairly negative.
Bitcoin's current correction isn't a failure of fundamentals. It's the predictable result of uneven demand. Lyn Alden points out that while the Bitcoin network remains rock solid and immutable, this cycle lacked the broad retail hardware wallet stacking that powered previous runs. Instead, demand concentrated in institutions buying through ETFs and treasury companies. That buying was real, but it was largely offset by long-term holders cashing out after years of gains. Coins held over a year dropped as people took profits to upgrade their lives. The result? Moderate new highs, nothing like the explosive doubles of prior cycles. This supply-demand imbalance reveals a deeper structural shift. Institutional capital is massive, yet profit-taking from early believers creates natural resistance. Every major bull market sees this rotation. Old hands sell, new buyers enter via proxies. The percentage of supply held long-term declines, but the network keeps functioning. What comes next is the key. With weekly RSI at historic lows and most of the Treasury company euphoria already washed out, some down 99%, The worst of the pain appears behind us. The market needs fresh demand to break the offset. When that arrives, the setup favors resolution higher, not another deep capitulation. Most investors are still missing how close we are to that pivot. The real runway ahead lies with profitable operating companies quietly allocating Treasury to Bitcoin as an inflation hedge, exactly the kind of corporate adoption that scales without career risk for most executives. Bitcoin's correction reflects temporary correlations more than any flaw in its thesis. It got lumped in with software stocks down 30% since October, despite being a fundamentally different asset. AI enthusiasm pulled speculative capital away from crypto narratives that had already exhausted ICOs, DeFi, NFTs, meme coins, while algorithms traded the pair together. Bitcoin now sits at some of the lowest weekly RSIs in its history. The setup creates asymmetry. While everything else ran, Bitcoin became oversold. The next risk-on environment should favor it once these temporary linkages weaken. Those focused only on near-term price action are missing how the structural case strengthens precisely when sentiment is this negative. Gold has run hard as the incumbent, but Bitcoin's trades position it as a complementary neutral reserve if it matures in liquidity and perceived stability. Alden owns both, and gun to her head favors Bitcoin outperforming gold over the next 2 to 3 years. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Make sure to check out our other videos on the crypto market, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
So I mostly agree with that. I mean, I think the overall network, obviously, Bitcoin is mostly immutable. It changes very, very slowly. It continues to function well as it always has. The part I would kind of touch base on is like, so the paper market is not the only issue. And I've kind of made this point a couple times. I think the biggest issue is there hasn't been a lot of top line demand this cycle. And that includes like on-chain, buy a hardware wallet, stack Bitcoin type of demand. So completely non-paper demand. If that had come in, the price would be higher. So I think the fact that that was on the weaker side this cycle left most of the demand in the corporate sphere, right? So most people buying either the ETFs in their brokerage account or buying the treasury companies in their brokerage account, or in some cases institutions, buying their other products. And that's been by far the majority of the demand for Bitcoin this cycle. And so that lack of kind of like broad retail demand, I think is the single biggest factor. And then we can add other things on top of that. There's a little bit of fear about quantum, which I think is overblown, but it is I think affecting price to some degree. The just the overall kind of paperization of Bitcoin is an inevitable thing that it has to go through. So I think there are multiple factors, but I actually think the number one thing is just kind of lack of top line demand, either in paper or if there was more buying. If there was a tremendous amount of institutional buying, then yes, we would see a lot of increase. Now we have seen a decent amount of buying, but it's been offset by a similar amount of selling from longer term holders. And that so far happens every cycle. So every kind of major bull market, you see the percentage of coins that have been held for say 1 year or more go down. You see some kind of profit taking. And the general trend there is not that those people have, say, lost interest in Bitcoin, is that they've been holding for many years. And they might have put, say, 5% of their net worth in Bitcoin, and it's up over 10x, in some cases many times more than that, depending on how long ago they bought. It could be over 90% of their net worth at some point. Many of them, they want to upgrade their consumption levels. Maybe they started a family, maybe they just, they want to consume more. And so you generally see selling from some of those older holders, and new buyers come in. Either directly or through these proxies, these treasury companies, these ETFs and things like that. And while we did hit new all-time highs this cycle, and I think we'll have higher lows wherever we hit as well. So there has been more demand than selling, but there's not been a tremendous amount of new demand compared to selling, which is why we only kind of we hit moderate new highs. Nothing particularly tremendous, not even a double compared to the prior high for the cycle. And so it's not that there's no top line demand, and it's not that the institutions don't move it. I mean, they have a tremendous amount of capital that they can move it with, but it's been kind of mediocre this cycle, and it's been offset by So I think quantitatively, the 4-year cycle is no longer relevant in the causal sense, meaning that the amount of new supply that is affected by the halving, for example, that's kind of the key catalyst for the historical Fourier cycle. That used to matter in the first three or so cycles. That was a tremendous difference in the number of new coins hitting the market. Now that most of the coins have been mined, the annual kind of supply inflation rate for Bitcoin is well under 1%. Um, it's a much bigger factor, the percentage of older coins being sold, than the halving. So I think that from a fundamental standpoint, the halving and the Fourier cycle is no longer relevant. But I do think that there's still a self-fulfilling prophecy around it, which is to say that many people still believe they're conditioned to the Fourier cycle. So I do think that there was some reflexive selling in quarter four of last year, with because people had the view that, well, I mean, if it was going to hit its peak, it's going to do it this quarter, and might as well get out and buy lower. So I do think that there's still some remnant of the cycle, even though there's no fundamental reason to expect it to behave like that. There's many other variables that can move it around going forward, is how I view it. And I think liquidity plays a big role. I think bubbles popping plays a big role. So, for example, in the summer of 2025, some of those MNAVs on Treasury companies just got really out of hand. I mean, Strategy, less extreme because it's bigger, but I mean, it was over three times MNAV at its peak. Metaplanet, got over as late as June of 2025 was at like eight times MNAV. In some of their earlier parts, they were higher, but even when they were pretty big, they got up to an eight times MNAV at one point. Many of the others were just euphoric. And I expected that to come down, but it came down actually faster than I would have guessed. I mean, I would not have guessed we'd go from, say, eight times MNAV on Metaplanet to one in a handful of months, but we did. Markets tend to, move quickly when they move. So I think that we've kind of had to burn off that bubble. Um, I don't expect us to have as big of a drawdown as last time. I think that some of the drawdown will be in those treasury companies. It already has been. I mean, some of them are literally down 99%. Other ones are down, uh, you know, kind of of what you normally see in a Bitcoin bear market, because I think that's where the euphoria was. I think there was not a lot of euphoria in, baseline unlevered Bitcoin. And so I think that, while it's obviously been a pretty severe market downturn, like something like 50% at this point, a little over at kind of the intraday lows, I think that we're not going to see one of those, like, 85 or 90% drawdowns is my base case. I think we're closer to the bottom than the top. I think most of the pain's behind us. Not to say that the bottom is certainly in, but I think the worst part of the sell-off is behind us. We probably have a grind to go through until we're kind of back in a true bull market. And I think that, yeah, the most of the pain was in the levered entities. Oh, I think there's always going to be military wars taking place. I think that I guess the question is, how do you avoid like World War III, like fight between the major powers? I think hopefully the biggest factor is that mutually assured destruction aspect, which is that an all-out battle doesn't make economic sense against an adversary of similar strength, which is why we see things like the U.S. Our focus is on Venezuela and Iran and things like that, that they're not like a domestic threat in any sort of sense like that. It's all this kind of geopolitical chess playing and things like that. As far as China being in gold and Trump being crypto, I don't really view Trump as being crypto per se. I mean, I think he pivoted to that to get political donations. He saw
Hmm.
that there's upside for being pro crypto. There's really no upside to being anti-crypto. Like Elizabeth Warren's anti-crypto army, there's no money there. There's no votes there. No one says, "Oh, I wasn't going to vote, but now that you're anti-crypto, I'll vote for you." No one, like, I mean, maybe like eight people. So there's a big money there. Um, you know, they haven't talked about the strategic Bitcoin reserve. They haven't added to it. They just kind of ring fenced the Bitcoin they already had, to some material degree. Um, there's really no emphasis there. I mean, obviously, from a personal standpoint, there's the meme coins, there's the DeFi, and I would classify a lot of those grift. But I don't think there's like a strategic Bitcoin focus here in the US or a strategic crypto focus in the US. I think that there's a strategy of just being more open to it than in China. Um, I think over time, in this more multipolar world, neutral reserve assets become more important. And this is something I'm talking about for years, and we've seen a huge run up in gold and silver and platinum. Um, and I think if Bitcoin gets big enough, it can become one of those neutral reserve assets that sovereigns want to own. I think, because of network effects and things I talked about before, and just kind of the path to penance of these things, they turn to what they already have. They turn to what's worked for centuries and millennia. They turn to what's big and liquid, gold. Tens of trillions of estimated gold market capitalization out there. So I think that's the incumbent kind of default winner in a more multipolar world. And then if Bitcoin becomes big enough and liquid enough and perceived as being stable enough, and some of these questions get answered around quantum and stuff like that, that's where it could also be a neutral reserve asset. So I think that instead of the U.S. dollar and the U.S. Treasury being at the center of everything, I think that in a more multipolar world, you have neutral reserve assets like gold kind of being at the center of everything. And then you have major currencies like the dollar and Chinese yuan being regional trade
The
major
structural
currencies.
tailwinds are already in motion. Liquidity expansion, institutional rails, and network adoption accelerate together. Those who treat pullbacks as accumulation opportunities rather than reasons to exit will capture the compounding. The move rewards patience and discipline more than timing. Miss this window, and the opportunity cost becomes permanent. Let's get back to the rest of the interview.
Yeah, I mean, so again, I try to be hesitant about reading into how absolute these things are. Gold and Bitcoin can go up together, they can go down together. Like they both sold off in March 2020 when we had a liquidity crisis.
Mm-hmm.
Um, uh, on average, gold is more risk off. It's an established, large liquid asset that's not changing anytime soon. It can be held without counterparty risk. Bitcoin is a 17-year-old asset. It's volatile. Until recently, institutions could barely own it. Now they around the margins they dabble in it. It's still widely held by individuals, many of which are just not known who they are. Um, there's questions around quantum, right? So it's perceived as a more risk-on asset. And then some governments are still opposed to it, so they don't like privacy or they don't like really big gains. So they say, okay, we're gonna do like unrealized capital gain taxes on it, or we're gonna imprison developers that make privacy, functionality that can be used with it. There still are these kind of technical regulatory volatility, uncertainties around it. So on average, risk off conditions will favor gold and risk on conditions I think will favor Bitcoin. We've seen AI has added a wrench to, risk on markets. So the really big mega caps that have been kind of the foundation of the US stock market bull run, they used to be very capex light. They'd make a ton of money. They had network effects on their products. They'd plow their money into buybacks, which is really good for the share price. And now they're plowing it all into AI capex. So their free cash flow in many cases have gone sideways to down, or in like Oracle's case, dried up entirely. And that kind of makes investors spooked around their share prices. Then they sell off the software companies, which have also been kind of a leading contributor to the bull market. So you have these more risk-off conditions, which I think has favored precious metals. But I do think, once the dust settles here and we have another risk-on cycle, I think Bitcoin will be a beneficiary of it. That I think, I mean, it's old advice, but I think diversification is relevant. I like to combine diversification with conviction. So I tend to overweight certain areas that I'm knowledgeable on and that I'm convicted about. But I still spread my bets out to some degree. I don't spread it evenly among everything, but I have a handful of buckets that I care about and watch and invest in. And to your point around, sentiment in gold and Bitcoin, it's funny because during raging, like I own both. I've written about both. I've owned both for many, many years. And when Bitcoin's in a raging bull market, it's like the it looks stupid to be diversified. People are like, why do you even own gold? Bitcoin is it just 10x, performance of gold. It's absolutely silly to own gold. And then, when Bitcoin gets cut in half and gold has a tremendous bull run, the my gold friends are kind of like, why do you own any Bitcoin? You made a mistake by being as interested in Bitcoin or even more interested in Bitcoin than you are in gold. It's like they forget that, Bitcoin's like up like more than 10x since I bought it. It's very kind of like short-term focused. They say, look, it did bad this year, therefore it was a bad idea to be in it, even though it's really outperformed. Um, Sentiment moves around like a crazy windstorm. Um, when you have a handful of assets that you are kind of focused on, I think it helps make you more objective because you're less tied to one asset having to outperform in a given time frame. And you're more likely to say, okay, well, this one's cheap, this one's a little bit expensive, so I'll err toward the one that's on the cheaper side that I'm still convicted about. And then it soars, and you say, well, okay, it's a little asymmetric, a little less asymmetric than it was before. I'll take some chips off the table, even though I still like the asset, and I'll put it in this other thing that I think is underowned. And I think that kind of gives you one, it makes it so you're never a forced seller, right? Because you're never like over levered to one position. And two, I think it helps you think clearly because no one asset has to succeed for you to succeed, and you're able to be clear. And then, ironically, when you're clear, you can make a pretty targeted bet on something with pretty high degree of
Timing
objectivity.
matters. By the time broad consensus shifts, the window narrows. Diversification with conviction, overweighting what you understand while staying balanced, keeps you objective through the sentiment storms. The move, when it accelerates, will reward those positioned before it becomes obvious. That's all for today, folks. Thank you for watching, and keep stacking.